Welcome to the Profit Answer Man, Roger Knecht. It's great to have you join us today.
It's my honor. I appreciate it, Rocky.
Can you share a little bit about yourself and your business?
Certainly. So, Roger Knecht, President, Universal Accounting Center. I work with accounting professionals. I'm working with the owners of bookkeeping, accounting, tax businesses to help them start and build their companies. I train the owners. I work with their staff so that they can offer quality accounting services. And as a division of our company, we also offer business consulting and advisory services. So I'm basically working as a business coach with a number of clients that happen to be business owners of small to medium-sized companies.
So you're very involved in the area of business finances and understanding what's going on in the business and helping people to do better at it.
Yes, knee deep and both feet. So there you go.
Nice. So how did you learn about Profit First?
Great question. You know, Profit First was something I was introduced to a number of years ago. I met both Mike and Ron at an accounting conference, and at that conference learned of what it was and read the book, thought it was amazing, but more importantly, I started to find that my clients were bringing it up in conversation, and so it was clearly a talking point. The book resonated with the business owners in the sense that they clearly started their companies believing that they would have not only freedom but financial success, and it was eluding them. They just didn't really realize what they were having, and all of a sudden Mike's purpose, the idea of eradicating entrepreneurial poverty, that resonated with these people. They felt like they were being successful as entrepreneurs, but not profitable as entrepreneurs. And so I was having this conversation with my clients and began dialogue with Mike and Ron as to how we might be able to help take that message even further into the accounting community.
Nice. And I'm sure you've got some great success stories.
I do. And here's what I'd like to share. When I was initially starting, and this was maybe 7 years ago, trying to determine how to actually go to the business community and speak of CFO and advisory services, one of the things that I was struggling with early on in those years is how to help the business owner appreciate the value of what CFO and advisory services consisted of. In other words, why would they pay for that service? What I quickly learned is of all the things that CFO could actually help them do, it's find a way to be profitable. And leading with the idea of profit first allowed me in my conversations to really improve my marketing, close more deals, and ultimately get more clients, because the business owners, of all the things that they were doing, one of which that they wanted to do better at is be profitable. And so it helped me actually start conversations as to how these business owners could work better, more deliberately and intentionally in their business to make profit a priority. And it actually complemented well a book that we had written called In the Black. And that book with Profit First really became kind of a talking point with the engagement that would extend over multiple years with the client. So it was phenomenal. I think more than anything, it in the end for my business clients gave them the ability to feel as if they were more intentional about their profit efforts. And for my accounting clients, the ones that I work with that are accounting professionals, it gave them a better way to explain of all the things that they were doing, what they were trying to help their clients with. And it's helping more money fall to the bottom line and ultimately into the pockets of our clients.
And I think that's a big part of it. I think a lot of accountants suffer from being in technical jargon, and business owners don't care that the reports are done correctly. What they care about is that they have cash and it keeps growing and
That's right.
They have money they can remove from the business, because at the end of the day, that's what they went into business for, to make money and to keep it.
Yeah, I've broken it down into 3 easy things that the business owners, when I say these 3 things, they're interested in talking to learn more. First is they want to know they have money in the bank. Second, they want to legally lower their tax liabilities. And 3, they want to be profitable. If I can talk to them about those 3 things, the business owner is interested in how I go about doing that. The fact that it's accounting that I use to achieve that, tax preparation, tax planning, that's all the how-tos that they don't really concern themselves with. They, at the end of the day, want to know that I'm going to help them have more money in the bank, limit their tax liability, and improve profits. Hey, let's talk.
And I agree with you. Taxes becomes a touchy subject because I find there is appropriate tax planning and inappropriate tax planning. And I think most business owners do inappropriate tax planning, which means they go buy the $100,000 pickup truck so that they can write it off instead of keeping the $100,000 and getting the write-off, because I prefer doing it that way, where you keep the money and you get the write-off, not where you give the money to someone else who then becomes profitable, and while you didn't pay any taxes, you have no cash flow and no profit.
Yeah, you gave away what you have for the truck, which may be nice, but now you don't have the cash. The liquidity of it's gone. I will address there's a sexiness to tax strategy. It's in the same category as CFO and advisory services. There's that creative component of working with the client and getting into this strategy of how. And that can be fun. That's exciting, and there's a lot of good money to be made there from an accounting services perspective. But there are better and different strategies that can be implemented with the client for sure.
And we like to use tax strategies that actually amplify cash and profit. So as long as those go together, then that's the key.
Yep.
A big thing that I'd like to talk about, though, is how do business owners go from red to black? How do they go from struggle to having more profit and more cash flow?
Well, I'm going to give it some context. This is what I'm going to say. When I'm working with my clients, initially, they want to portray themselves as being very successful. They've got the revenue, business is good, everything's great. But after I've worked with the client for a period of time and they become a little bit more comfortable and there's a safe environment where they can be more transparent, or I get access to their financials, I quickly realize they're not as lucrative or profitable as they perhaps imply as they present themselves from a revenue perspective. So clearly, we're talking about cash flow. All of a sudden, the truth becomes known that they're working really hard and they're very busy, but they're not as profitable as they'd like. And so that brings up this question of being in the red versus being in the black. And that cash flow question is one of the most common challenges I face with a lot of the clients that I'm working with, where they would like to actually figure out how to manage the gap between accounts payable and receivable so that they can, in fact, not be the bank for their clients. And that's a big conversation because, yes, they're selling a lot, but they're possibly, leveraging lines of credit, business loans. They're basically becoming a bank for their clients. And what we want to do is address that business model and help them realize how can they expect more from their customers up front so that they can pay for a lot of the COGS associated with that product or service, pay for the payroll that may be associated with creating or delivering that product or service. And in the end, before the customer pays for the delivery, they're able to now, as a business, be profitable and successful without that scenario of one customer paying for the other customer. Those things are just not effective business models. And so rather than going bankrupt yet being profitable, let's go ahead and implement some very proven cash strategies. And there's a book called Red to Black that addresses 6 steps that we do as accounting professionals with business owners to turn them from being in the red to being in the black, being profitable.
I'm trying to think of how you exactly phrased it, but you said when they come to you saying they're doing well. Mm-hmm. But a lot of times I think they think they're doing well because they're selling.
Yes.
Not because they know what's actually happening. As long as money's flowing, everything's wonderful.
They're busy.
But they don't realize that there is a problem with that flow, and it isn't so wonderful, I guess.
Yeah, I'll give you an example. Sometimes what I do is I walk in and the business owner is very happy with the work that they've done so far, but a lot of it isn't in cash. It's not in the bank. It's in receivables. And so they're very content with the fact that they've got all this money owed to them. They're paying the bills and they're thinking that the money's going to come in, and they make another sale and they'll sell, let's say, three projects. Well, 2 of the 3 are financed. 1 is paid up front. Well, the 1 pays for the 3. The other 2 they're hoping will pay eventually. That's where the profit lies, and kind of runs into troubles, maybe doesn't pay in a timely manner, maybe doesn't pay at all and defaults. Well, they're having enough cash going through the business that they're not paying attention to these nuances. And when you look at the receivables, yeah, they've got $1 million in receivables, but let's say 500,000 of it is more than 6 months old. They might as well be looking at writing a lot of that off. And so we're in a position where they're neglecting the receivables. They're not sending out the notices, the invoices, the late notices. And because of that, their receivables are aging and they're getting to the point where they're never going to collect on them. And so as a advisor, as someone coming in to address this, we're now able to start talking about things that we can do to accelerate those receivables, bring in those monies, collect on the monies owed. And all of a sudden, that business owner who was neglecting or losing money on the backside starts collecting it. And so these are some strategies that we implement with our clients to really take what they're doing so hard as they work and give them the money they deserve in relation to it.
It's funny because none of my clients do this because I wouldn't allow it. But I see it on their end. They're like, well, the job is complete, but the P&L for the job is wrong because I still owe people money. And I'm like, well, don't you have the invoice? And they're like, no. And I'm like, but it was 60 days ago they did the work. Why aren't are these people who you were working with independently rich that they don't have to bill you? And, at the beginning of the day, if you're not invoicing your client, that's a major flag because, hey, I'll be honest, I look at my books and I go, what is that? What did I spend on? I forget.
Yeah.
Right? I think we all do. So if you don't invoice quickly or immediately, you forget. B, it delays the whole process. And I think I see that a lot, especially in the trades where things are just so far behind that they don't get done. And I guess when they finally need the money, maybe that's when they send the invoice. But depending on who you're working with, they might have moved on.
That's right. And I'm going to throw some salt into this wound a little bit. I'm going to give you two real examples. Let's assume, for example, you, Rocky, are the business, and you're sending me an invoice, but you've sent me the invoice 90 days after I expected it. Well, first thing is I've probably taken the money that I originally allocated to pay that invoice, and I've now spent it because I forgot about owing you. So your invoice never comes. I don't realize it. You've delayed sending it to me, so I've taken the funds and spent them elsewhere. You give me the invoice, and I'm like, oh, crap, that's right. I never did pay Rocky. I do owe him. I realize it. I'm being honest. I recognize the fact that I had you do something for me that I haven't paid for. But again, it's 90 days, and I've spent the money, so I don't have it to pay you. But here's the second thing. How about you send me that invoice 90 days later? I admit that I owe you the money, but in the back of my mind, you go, Rocky obviously doesn't need the money because Rocky sent me this invoice 90 days later. I'll pay him in 90 more days. I have other people that clearly need the money because I just ordered this and I got the invoice immediately and it said due upon receipt, and I'm going to pay that one. Yours might even say due upon receipt, but it's 90 days later. Rocky's doing fine. I'll pay him in another 90 days. You're 180 days removed. You're needing the money tomorrow because that's why you sent me the invoice all of a sudden out of nowhere today. Well, look at the logic. Either I've already spent the money because we're so removed from the actual event that I've spent it and I need to go, crap, I've got to save the money now to pay you. Or two, I'm of the opinion, well, Rocky clearly doesn't need it, and I've got other vendors I owe, so I'm going to pay them first, and I'm going to put you at the bottom of the pile because I got it late. These two lines of thinking that are going through the minds of the recipient of that invoice are common, and yet you need the money, and yet you sabotaged yourself for the mere fact that you were late in sending out that invoice. I have nothing else to say other than it's a very real occurrence.
So before we even send the invoice, I think there's another problem that occurs before that.
Okay.
And that is, did we price it correctly? How did we come up with our pricing for what we're going to invoice? A lot of times they'll look around and go, well, so-and-so's charging that, so that's got to be appropriate. Or they guess at what it is, and they use inaccurate measurements or inaccurate inputs, and so they don't have a good process in place to ensure that A, they're doing it, and then B, there's all this guilt on the part of the owner. Well, they won't pay that much. I can't get the sale if I don't do that. What have you found?
Well, two things. There's a variety of ways to come up with the price itself. So that's the first part. You can do, say, cost plus, where you're basically determining what it is to actually perform that product or service, and then you just mark that up. You could look at the marketplace and forget what it's costing you. It's just what's the marketplace demonstrating, and you just take that, and that's however you come up with your price, the first thing I'm going to add is you need to consider the default ratio. one of the things that we don't consider is what percent of the invoices I send out end up being written off. Well, I need to mark up all of my invoices to cover for the ones that are defaulting so that the customers who do pay for the one who's the schmuck, okay? So that's the first thing that we need to do is whatever you come to as a price point, it needs to go up even further so that everybody's paying for the schmuck that we've got on the other end that won't pay us at all. So we've got to incorporate that one element. But the second thing I'd point out is in small business, what I'm about to describe is very common. You as a small business owner, oftentimes as the owner, feel that the people you're working with are friends, family, there's a relationship element to the transaction that you feel like you don't have the right to ask them to pay for things because we're friends and I don't want to rub this wrong. And so I neglect to actually have you pay up front a percent of the costs associated with this product or service. So all of a sudden, instead of saying I need 25% down, 30% down, 50% down to cover the COGS associated with me buying the materials to deliver that product or service, the payroll necessary in the next 30 days for me to do the work, what I do is I front that for you. And because we're friends and I just don't want to ask you for any money because I haven't done anything yet, I front it for you. Well, I'm still now having to pay payroll. I'm still having to go to the store and buy whatever product or service I need or product I need to deliver what you've just bought from me. I'm incurring all these expenses and you haven't paid me a dime yet. And so there's a cash flow issue. And that issue is because of the fact that as a business owner, I put the friendship ahead of the professional relationship, and now it's going to cost me, and it's going to sour that relationship. We should have been professional from the get-go, peer-to-peer, business owner to business owner, business to customer, and I should have said, look, in order for us to do this, I need this percent up front. And that's where the accounting comes in so much. The CFO, the role of the CFO is to help the business owner understand what cash flow is needed for the business to cover the associated costs so that I'm not upside down from the get-go with this clientele. If the CFO could come in and give us a perspective of needed cash flow to deliver that product or service, I could have my salespeople, myself, asking for the appropriate down payment, and then we're servicing the client comfortably. We're not stressed. We're not experiencing this anxiety of, I don't have the monies to pay my people. I don't have the monies to pay the bill for the inventory. This is a good business discussion to be having. It
is, and well, most of this stuff has to be done proactively, not reactively.
Very true, yes.
Which is a big part of it. What I have found, though, and again, it goes across a variety of businesses. When you're doing something that you're building for the client and they have to give you final approval for the final bill. If you do the 50-50 billing, we were just having this conversation earlier today. When it comes time, a lot of times that schmuck client won't sign off. They'll hold you up on 50% of your bill because of 0.5% of something not completed. And so what we've started to tell clients is, okay, 50% up front, and then the next 40% on a schedule or on a or a percentage of completion basis, and only holding the last 10% for the final, so that if you end up with a bad client, you at least have 90%. And here's the thing, a lot of times life happens, right? Just as it happens for us, it happens for our clients. Something happens to that client, you're only out 10%.
What you're describing is the fact that from a cash flow perspective, we've been able to assess, okay, here are the risks, and let's try to mitigate them, and let's give some incentive to the client to actually pay us up front like this. I'm willing to give them kind of a discount of sorts if they do cash up front and pay in full for the entirety of the product or service from the get-go, because then I'm not having to worry about managing receivables. But if they're unwilling to pay up front for the entirety of it for that little savings that I provided, then I'm going to say, okay, then pay me midway, and you're going to pay this in portions. And like you're describing, then at the end of the day, if it goes wacky, I'm not in a position where I've lost everything. At least I've got 50%, 75%, 90% of the revenue associated with this project, and I'm losing out on that last 10% versus I'm losing out on 100%.
So that comes down to a sales conversation. It's $12,000 for this project. However, I'll give you $2,000 off if you give me 50% today, 20% in this day, 20% in this day, and then the final 10 when we're complete. And so now it puts it back onto the client side to say, hey, I'll do that. But honestly, if they don't take the discount, you just got a red flag that you should be a little bit more careful on who you're doing business with.
Well, and you have to accept the fact that you've just extended a line of credit to someone. You're a bank at this point. You're fronting the money. The moment they've decided to not pay you in full, you've actually identified that this is a person that you're going to have to fund in one way or another in their behalf until this is done. And that changes the relationship.
And that's why I made sure to put the extra money into the proposal to cover that risk. And now you look nice because you're offering a discount, right?
Yeah, and one of the things that I really like about this discussion is I think so often many business owners don't get this intricate in their pricing to understand the ramifications of how they're taking monies. And when you bring into it a sales team, a sales group, you're paying commissions typically on these sales that are occurring. The product hasn't been delivered, the service hasn't been provided, and yet you're paying a commission on the sale. The salesperson is whole. They're basically excited. They got the transaction that they were looking for. And if they were financed, and all of a sudden you're thinking as the business owner, hey, I've got a project on the books. You've paid the commission, but now you're chasing all this stuff after the fact, and you need to have upfront at least enough monies to cover your upfront costs. Otherwise, you're starting well behind the curve on this one.
And so in this particular situation, if you've done it that way, you've incentivized the salesperson to sell, but not to make sure that you can collect. And so be careful what you incentivize because you will get it. And so when you yell at the salesperson, go, you need to sell this month, he can go out and sell and he's not going to care what happens because you've incentivized that behavior. So be very careful what you incentivize to your people.
Oh, you nailed it. There are so many times I've gone into businesses, and one of the things that we've identified very quickly is that the wrong carrots are out there. The wrong incentives are in place. We need to be more transparent with our people as to what truly is a success and what we're expecting of them. And sometimes we're rewarding, and just because we're talking about salespeople, we're rewarding them for, let's say, the number of contacts they're making, the dials they're making, the proposals they're submitting. Let's reward them for the one thing that matters most, and it's closed deals. But it's also from the perspective of what's truly a win for the company. And sometimes it's revenue-based, not just closed deals, it's revenue-based. How much money did you bring in? And if we can put the right carrot in the right place, all of a sudden what happens is we motivate the right behavior. So it's a big thing, and it extends throughout the entire company. I refer to this as key metrics. What are the key metrics that every employee is responsible for, every department's responsible for? What's the key metric in the business that we all need to be following? And if we do our one thing, we each contribute to the success of the business in our way.
So I'll take that a step further. I try not to incentivize really on revenue because we're profit first. So we prefer to incentivize sales reps on their profit margin and their gross profit of the deal so that they truly are making sure that they're getting, because otherwise, what difference does it make if he knocks 20% off the deal? If he's got the flexibility to do so and he can close the deal and go play golf, what does he care? He doesn't. And so, but if he's incentivized on that gross profit and he just gave away all the profit, well, now he's not getting paid, so he's going to make sure he fights for your money. And that comes back to what you talked about, right carrots.
Well, in that context, in my business, the way we incentivize is we actually pay differently the salesperson for paid in full versus financed agreements. There is a different margin there, and so I will pay accordingly. And the way I pay it out, I'll pay up front the paid in full. I will pay over time the payments because the moment the customer defaults, you'll get your sales commission of $0 just as much as you'll get your sales commission of whatever dollar amount it is. So if you're getting 10% of $1,000, you'll just as easily get a 10% commission on $0.
And that is so important. So one of the things that you talk about in one of your books is what to expect or what not to expect, but what to ask of the people who are helping you financially and coaching you financially and advising you. So, what are the things that they should look for from the people who are helping them as the business owner do better financially?
I really appreciate you asking that. So when I started 7 years ago working with business owners directly and finding out what it is they needed, especially as it related to CFO and advisory services, one of the things I quickly came to understand is there's a huge disconnect, in my opinion, between what the accounting profession is communicating we do for business and what the business owners are expecting from accounting professionals. Let me just give you an example. When I asked business owners what is it they're paying for and can expect when they're paying for, let's say, accounting or bookkeeping services, what they explained bookkeeping is for them and what they thought they were buying. And then I went to the accounting professional and I said, what is accounting? What is bookkeeping? The definitions were totally different. What they communicated was incredibly off. And so what I found is this disconnect was causing confusion and frustration. And so I wrote a book called Your Strategic Accountant. And the book was written with the intent of trying to help the business owner to first of all understand what they're paying for, and in turn, helping the accounting profession explain better what it is they're doing. And so one of the things that I wanted to explain is that there's a difference between 6 of the services that exist in the accounting profession. 1, what is bookkeeping? What is accounting? 2, what is tax preparation? What is tax planning? And 3, what is CFO and what is advisory services? So do you mind if I actually explain each of these very quickly for your audience?
Do that, but for number 2, I want you to really explain the difference between those two, because I think they're split apart.
Good. Okay. So here we go. I'm going to go through these very quickly, and then we can dive into any of them as you would like. So for the listeners, what I'd like to point out is the distinction between bookkeeping and accounting is very, very simple. The first thing is that you've got bookkeeping. It's the recording of the transactions that are occurring in the business with the intent of providing accurate and timely financial reports. At the end of the month, what we're wanting are, first of all, profit and loss statements or income statements, balance sheets, and cash flow reports. If the bookkeeper is producing those reports in a timely manner, then the business owner is getting the information they need to run their business. But here's the caveat. It's the accounting professional that is meant to actually take those financial reports and interpret them for the business owner. It's from there that the analysis is being done. So the accountant is honestly taking those reports and taking that information and putting it into numbers, margins, metrics that the business owner can use to make informed business decisions. So let me give you an example of what an accountant may be doing. They may be taking last month's financial and comparing it to the previous month's financials. They might take last month's financial and they'll compare it to the same month last year financial and see how the twos are comparing. They're going to take this year and compare it to last year's financials. Those comparisons, they're going to be able to answer questions as to whether or not cost of goods have changed and a certain gross percent is falling from total revenue to gross profit. If I'm actually experiencing that last year my cost of goods were, let's say, 10% of total revenue, this year they're 25% of total revenue, well, that means less money fell from revenue to gross profit to pay my bills, and more importantly, I need to raise my prices because my costs have gone up dramatically. So as a business owner, I knew things were more expensive. I knew they were costing me more money. I knew I needed to raise my prices, but notice, until I heard from the accounting professional that they changed from 10% to 25%, I didn't realize that it was a 15% increase that I needed to actually now do in my pricing. I knew I needed to raise the prices, but now I have a greater understanding of how much. And that's where the accounting professional can come in and say, here's what's changed with cost of goods. Here's what's changed with, let's say, advertising as a percent of gross profit, payroll as a percent of gross profit. Now I'm, as a business owner, able to be making more informed business decisions. Let's go to tax preparation and tax planning. Tax preparation, great service. It's where we're actually working with the tax preparer to ensure that we're filing in a timely manner our tax returns and getting those done so that we don't have to worry about extensions or late fees. But a tax planner is that strategist, the advisor that's coming in and helping us with tax advisory so that we can actually implement various things related to the tax code or tax law that we can use to mitigate our tax liability. It's giving us strategies so that we can actually run our business more intentionally as it relates to the tax code so we pay less in taxes. us. That's a huge deal, totally different than the tax preparation. Let's go to CFO and advisory. CFO is essentially helping us manage the cash flows we've been discussing already. And in addition to the cash flow, they're also helping us with capital, how we're working with cash, let's say lines of credit, business loans, where we're getting the capital from venture capitalists. They're helping us actually with those relationships so that we have the monies we need to run the business, and we're operationally making decisions such as like with payroll. We discussed earlier the sales position. It's clearly, are we paying people correctly in the organization as it attributes to the work that they're doing for us? This isn't a bookkeeper role. It's not a tax preparer role. It's a CFO role that we're providing to the business owner. And then the last is the advisory services. I look at this as basically saying we're beginning with the end in mind. What's the exit strategy from the business, and how could the advisor help us so that we can build an organization that is worth something? This business is an asset. The advisor is helping us address things that are helping us build worth in the company, value in the company, and ultimately that might be established through, let's say, EBITDA or some other valuation, but the advisor is helping us address the risks in the company and address those so that we actually use them as strengths to build the organization and have a company that the business owner can be proud of.
And I think most business owners only have the first two, and they're not getting what you talked about, which is all the different percentages that they can understand. Most of them aren't even looking at the reports. Some of them aren't even getting the reports.
Yes.
And then most people assume their tax prep person is doing their tax planning.
And they're not.
Which is usually not the case. So
that's right.
I think that was super helpful in just making it clear what people need to look for and understand the different roles. And if you're not getting what you that's part of the conversation before you even sign on, to say, this is what I need. Are you able to provide this, and do you provide this? Because a lot of people don't, nor can they, even though they've got the title.
Yeah, so let's look at it from the business owner's point of view, which is what the book is addressing. I go in and I hire someone to do my taxes, and they're offering tax preparation services, but at the end of the day, I thought they were going to advise me. I thought they were going to give me suggestions. I thought they were going to address things like, let's say, cost segregation for the property that I own. Well, they don't do cost segregation. They just do the filing of the return and they're done. But I thought somebody was going to come in and assess how I can depreciate these things with an accelerated depreciation and offset some of my tax liability. I thought this because this is what I heard tax people do. Well, you didn't do it, and I shouldn't have expected it because it was never discussed, and I clearly am not paying for it. But the tax preparer might have said, oh yeah, as your tax preparer, I do some tax savings things. Well, just that line alone implied that I was going to be doing tax saving strategies, but that's clearly not what I'm paying for. So as a business owner, I had a misaligned expectation of that relationship, and what I'm trying to do in the book is try and clarify, this is tax preparation, this is tax planning. Which are you paying for? Which are you offering? And is there an alignment with that?
And that's a big part of it. I think it's just an education for the business owner to realize that there are differences, know what they are, so that you can ask for the appropriate help that you need, and you put the appropriate people on your team to get the results that you need to succeed. It's
exactly
that simple.
Yep, exactly.
If people would like to learn more about you, find out about your services, what is the best way for them to do that?
LinkedIn. If you would like to, you can link up with me, connect there. I'd be more than happy to communicate with you. You can also go to our website, universalaccounting.com. It's there that I offer a number of free resources for business owners, such as the book I just mentioned, Red to Black, In the Black, as well as your strategic accountant. All of those are available for free. If you'd like to read some of these ebooks, happy to share those with you.
Thank you so much for joining us today, Roger.
It was a wonderful conversation. Rocky, thank you for having me on the show, and always remember this, if it's about accounting, it is universal.
Thanks for listening to this unedited video of the Profit Answer Man podcast. If you'd like to catch the full episode and learn more about what we do, check us out at profitcomesfirst.com. We also go through the Profit First book in each and every chapter in the beginning episodes of the podcast, so check those out as well. Thanks for listening, and here's to you having a more profitable and growing business.